Perfect. Steve, Randy, Scotty, how you doing? I don't know if they can talk to us. I don't think so. In webinar mode.
They can chat though.
Yeah, you guys can chat. Hi, guys. That's like a little webinar party. This is nice. I appreciate y'all coming. It's really weird not being able to like talk to you and converse back and forth. So I just gotta kind of ramble on to keep you entertained, right? So in the meantime, I'll introduce Michael. Michael is my brother-in-law. That's pretty cool. He lives in Calgary and he loves it. So yeah. Just so you guys know, I'm gonna start this right at 7 because I'm an on the dot kind of guy. Introduce yourself, Mike.
Yeah, my name's Mike Stoner, and live out here in Calgary. Been out here for about 3.5 years now, and yeah, absolutely love it. Looking forward to telling you guys more about Calgary as we hop into the presentation here, and I think why it's a great place to invest.
Yeah. I guess like when you do, sorry, this is all new for us guys, just so you know, the whole webinar thing. So we're kind of learning, you guys are guinea pigs. But yeah, it keeps people quiet. You don't have all the mics stuck on, but it would be nice to talk to people because there's people here that I would love to talk to. But we got another minute, we're gonna get started here. Oh, chat's disabled. Do we know how to turn that on, Mike?
Let me see if I can do that.
See, good friends text you about chat being disabled. Who here wants a rate decrease in June?
Because they can't. Scott raised his hand, so
so they can raise their hand.
But you can't chat.
Check on my hand. Survey Q&A. Yeah, I don't know. We'll have to play around with it. Yeah. We'll figure it out for next time. We can chat. For now, you guys are just gonna have to listen to me because yeah, that's the way it is. You guys are probably gonna hear my phone go off a couple times throughout the evening because I forgot to put it on silent. So we'll just do that now. It's gonna drive me crazy.
It looks like if people do have questions as we go through, it does look like there's a question and answer section here. So it looks like you can just click on that box down at the bottom and you can go ahead and ask a question. So hopefully it all works out. And
now we're gonna have fun. All right, bring her up, Michael.
Okay, here we go. Okay.
Boom. Okay. So we're going to talk today about investing in Calgary. I'm going to share some stuff about our portfolio that we've built over the last 14 years or so. Mike's going to shed some light on projects that are available, and we're going to break down. You're going to have to bear with me. You know, I'm trying to explain this stuff as, you know, as clear and concise as I can, right? But it's like, it's all stuff that I did. So I really want to teach you guys this because I see immense opportunity in Calgary. So, all right, go ahead, Mike. Alrighty, so a few thought-provoking questions that I want to ask you guys would be these three on the screen here. So if your house keeps appreciating at the same rate, will your kids ever be able to afford a home? So, about 15 years ago, I bought a house in Bowmanville for 200,000 and now it's worth $1 million. So it's 5x in 15 years, right? And I think it would be naive to think that we won't continue on the same path. It doesn't make sense to me that we would think for some reason everything's just going to stall and it'll be fine, right? So very real possibility. 15 years from now, the average house to buy, like that house I paid 200,000 for, is going to be $5 million. If you're not in the market now, I'm telling you right now, you cannot save money fast enough to get into the market if you're trying to afford the area that you're in. Like, so let's say you're trying to buy in Durham, and it's like, well, everything's 700,000, and I can't afford 700,000, but I can, afford and get approved for 400. Well, then you got to get creative now and buy something somewhere. Okay. And then finally, like, have you owned your house for like 10 years and you only owe, a couple $100,000 on it, and you have all this equity sitting there and it's untapped, and you have room in your credit, you have the ability to borrow more money. So this appeals to pretty much everybody I know. So that's why those questions are there. Go ahead, Mike. All right, so who am I? Most of you guys know who I am. I hired on right out of high school and to the CP Rail. I was a freight train conductor, and my best friend's dad invited me to a free beer and wings night for real estate. And I realized that I could afford a house, and it just kind of made sense to me. I only had to put 15 grand down on this first investment in Bowmanville. I paid 207,000 for it, and today it's worth 875. But while I was at the railway, I kind of realized, like, hey, my net worth is actually going up from these two houses I bought at a quicker rate than I can save money, right? And I kind of became passionate about it, and I thought, I got to sell this stuff. So now I've been in real estate for 11 years. We're like top 50 RE/MAX agents in the country. We had a net worth of over $3 million by the time we were 30. And, that is all from real estate investing. It's not from selling. Like, we do well selling, but it's our net worth has always come from holding on to real estate. So why do I tell you this stuff? Because you know what? I honestly think if you're going to listen to anybody, you got to take, you want to be careful where you gather data, right? So you want to gather data from somebody who is credible. So I feel like I have the credentials to teach you, basically, right? So, all right, next one there, Mike. So yeah, why invest in real estate? You have to invest your money in something, right? Cash just sitting there is just eroding due to inflation. Your buying power goes down every single year. So you got to do something with it, right? And, today I'm going to teach you that this is a very good option. You want to build wealth for your next generation. Like, it is getting consistently harder to survive in this country. So it's almost, we got a plan for our kids. Like, it's just the way it is. I'm telling you right now, we got a plan for them. You can take advantage of leveraging your money with real estate, and there's not really many other investments that you can do that. We're going to talk about that and the powers of leverage and compound interest. So these properties, like my first investment in Bowmanville there, some of them you can buy. The ones we're going to show you today, you can buy them and you close on them. And it's like, it costs you nothing per month, and you actually get a couple $100 extra a month. So it's like my first house, total carrying cost was about $1,300, and I was renting it for $1,500. I'm like, okay, wait, so I'm getting a free house paid for, plus I get an extra $200 of spending money a month. Okay, let's do it. Thanks, Mike. All right, so one of the age-old things, these sayings that people like to say is, "Old can't go up forever." It has literally gone up forever. I don't know where people come up with that saying or why they keep repeating it, because it's literally the dumbest shit I ever heard. So here I have some interesting facts about real estate. The first one I want to mention is there is no correlation between average wage and home prices in major metropolitan cities. Okay, that's people's argument all the time. Well, can't go up forever. How are people going to afford it? The people that cannot afford it do not own real estate. That's the way it goes. And it's actually heartbreaking if you think about it, because everybody should be able to own their own domain, right? But this is just the reality. So look at this chart here. These are the 20 most expensive cities in the world for a 2-bedroom, 2-bathroom condo per square foot. And then next to it is the yearly wage. So why can their prices go up forever, but ours aren't supposed to? No. Canada in the next 8 years needs to build 5 million homes. The most homes we've ever built in that 8-year span is 2 million. There's going to be an increasing demand as years go on for real estate. That's why it appreciates at an exponential rate every year. So take a look at Calgary. Their average income, their average wage is actually quite high on the list. You know, there's only maybe 5 or 6 of them that are higher, but the cost per square foot is only $450. So it's like, seems like a bargain, right? Well, eventually, due to price, people have to live somewhere, and these places have to catch up. So Toronto, $925, Vancouver, $1,200. Calgary is not half as nice as Toronto. I've been there. It's quite nice. Mike lives there. He loves it. So, you know, the fact that they have an average wage that's higher than most and a cost of living that's super cheap and low taxes, don't you think people are going to be happy there, and it's going to continue to attract people, and prices are going to catch up to the rest of the world? Are we way different than the rest of the world here? No. Like, we're just a new country. We're a freaking outpost in North America in the Great White North. That's all we are, right? It's like, you know, it's going to be the last place to appreciate. Like, you're going to choose here or Florida. You're going to go to Florida until it's too expensive, right? So, you know, $450 per square foot on this list seems like a bargain when Calgary often ranks in the top 5 of quality of life for major cities in North America. So that's pretty cool. All right, sorry, I can ramble on about this stuff, guys. There's a few buttons of mine that get pressed when I hear the same rhetoric over and over again. It drives me crazy. All right, high immigration rates in Canada. Nobody understands why we have all this immigration coming in. But we're like, you know, where are the people going to live? We can't bring the people in. There's no houses. We can't afford the houses. You know, what's going on? Well, we're kind of in between a rock and a hard place here, because the baby boomers are all retiring at the same time. And they have to be replaced, and we have to add to them. That's why we're bringing in 500,000 people a year. You know, it's actually more than that that's just permanent residents. When you factor in everybody on visas and everything, it's actually closer to 1 million. If all the baby boomers go from contributing to the system to being a draw on the system, then and we don't have workers to replace them, the system fails. So that's why we're bringing in all these people, and that's why it ain't going to stop anytime soon. You know, Canada is a good place to live. It's feeling very expensive now. I know we're all feeling it. And but ultimately, it's very safe. We have healthcare. You know, it's not that great, but we have it. You know, most places don't even have it. So people are never going to stop coming here. If you think about the countries they're coming from, our first, like the place where we get the most immigrants is India. People from India are not going to stop coming here. Plain and simple. You know. Then the next interesting fact is about the fact that, you know, a lot of people in other cultures, and I would argue Canadians too, like Canada, we're very proud homeowners. Like, everybody aspires to buy a house and own a house. And I think it goes beyond just the investment side of things. It's sense of pride and everything. Well, in India, it's seen as downright disgraceful. So, like, when they come here, they're going to buy whatever they can. And it's like, if they're coming from one of these cities on here, I wish I knew my geography better to tell you which cities in India. I guarantee you there's one of them here somewhere. But it's way more expensive here or there. So they're coming here and they're thinking, wow, $450 a square foot. What a great deal. But anyway, all of those places, which are some of our major immigration sectors, none of them want to rent. Canadians don't want to rent. They prefer not to. So people are not going to stop buying real estate. Yeah. All right. Now I'm going to teach you about compound annual growth rate. You guys ever heard that compound interest is one of the wonders of the world? Well, it is. So this is like what your property goes up every year, right? So if we go up 5% this year and 5% the next year and 5% the next year, it doesn't equal a 15% spread. It's much more than that because it's compounded, you know? So yeah, this is how it works. These are the numbers from Oshawa and the rate that it appreciated over 20 years. And this is the calculation you use to get it. So 20 years ago, the average single family detached house, like in 2003, was 178,000. Man, don't you wish you could just go buy like 7 or 8 of those right now, eh? In 2023, so this is after the dip. You know, February 2022 is the peak, and we've just been on this colossal, you know, correction type weird market since then. So this is after the dip, right? 8.41% a year. Okay. So that is that compound rate. It's not a flat 8.41% a year. So go to the next one, Mike. So here I'm going to show you the power of this, right? Now, I want to sell you guys on the proper way of investing in real estate should you do it, okay? Because nothing's guaranteed unless you plan long-term, okay? So we want to plan extremely conservatively, but on the other hand, you also want to be aware of what is possible because it can help make your decision, okay? So this is the power of that compound growth rate over time. You know, time is your friend. This is our entire real estate portfolio. So I've been collecting this stuff for like 14 years now. And for the first time ever, I am going to be selling my Shand property and my Crerar property to invest in Calgary. We'll get into more reasons why later, but it's better. This is pretty wild. You know, like take a look at the Calgary condo over 10, 20, 30 years and how it appreciates. I'm using 3.8%. And why did I pick that number? It's kind of random. Because that is the rate that from the year 2000 to 2020 that wages appreciated at. So wages went from 20,000 on average to 40,000 on average in that 20-year span. That represents a compound annual growth rate of 3.8%. So I think most people can comprehend the fact that real estate outpaces wages in major metropolitan areas, right? So that's why this is like uber conservative. So keep in mind, the tenant is paying for the house. You're not paying for it. You're responsible for the down payment. That's your contribution. The rest, the other 80%, is the contribution of the tenant over time. So it's pretty wild. Our primary residence, it's a big one. I don't know if I'd recommend it, by the way. Big house. I don't know. We're on the fence. In 30 years, with that super conservative appreciation rate, it should be worth $8.5 million. But if we use the 20-year average of Oshawa, and the rate of appreciation is accelerating over time. Like look at the thing at the bottom there. Over the last 20 years, it was 8.41%. Last 30 years, 6.5. Last 50 years, 5.7. So it's like, it's gaining momentum over time. So it's like 8.41 theoretically could be conservative as well. But it's like, this sucker's going to be worth 40 million bucks. There's a very real possibility of that by using real numbers. But like, I'll be cool with 8.5 too. And then all those other properties there, the tenants are paying for it. So you get a free at least 19 million bucks in this scenario if this was just a rental portfolio. Like, I understand these numbers are hard to comprehend. Like, who's going to pay $40 million for a house? Somebody will. They're paying 40 million in Toronto now. It's crazy. So if it can be that there, it can be that here in time. But like, I want you to understand the spread from 3.5 to, 39 million, that compound interest or appreciation is the same as that little house that I bought for $140,000 in 2012 in Oshawa to it being worth 600 today. It's the same spread. And like, you just watched that happen in front of your face. So I don't know. It's not unrealistic, as insane as it sounds. All right, let's throw in the next one here. Okay, so this is, I know there's a lot of numbers and things on the page here, but this is how you calculate your return on investment. When you buy a house, your investment is not the purchase price, unless you pay cash, which would be stupid when you can leverage. And I'm going to show you why. So this little house here, real world example, it's the second house I bought in 2012. I paid 140 grand for it. My down payment was $7,000, if you can believe that. Lawyer fees, 1,200 bucks, land transfer tax, 1145. Total investment, 9345. That's my investment. Despite the fact that I'm carrying an asset worth 140,000. So like, think about this. I have 9,000 invested, but I'm actually of my own money in the house, but I'm actually investing 140,000. And I just have to figure out how to hold on to this thing over time, right? I got the mortgage details there. Rates were the same as what they are now. So a 5% mortgage over 25 years. I owed 133,000 on it. If you're interested in how to collect or calculate mortgage payments, there you go. Gives you mortgage payment of $776 a month. We've got $9,000 a year. Carry that on. That's the total payments for 5 years. I got the rent income, which actually was $1,350. I just found out, not $1,300. So the return's a little better, but looks good enough here. Total rental income over 5 years. You got to factor all this in. Like, it's hard to calculate the return on real estate. People don't do this. They just think like, oh, the house went from 140 to 280, so you made 140. Yeah. So it's 100% return. No, that's not how you calculate it. So 100% is exciting, but in 5 years, it's not that much, 20% a year. I know. When you're talking about stocks, that's a lot, but we're not talking about stocks, we're talking about real estate. All right, so profit from sales, selling price 285, original purchase price, there you have the profit, total rental income, mortgage payments, property taxes. You figure out your net cash flow. So it's like, I own this thing for 5 years, and in 5 years, I collected $17,000 in positive cash flow, like just in my pocket, extra above expenses, So let's say that went away in maintenance, for argument's sake. Doesn't matter. Return's going to be crazy anyway. So your ROI is your total profit divided by your initial investment. So we got to take 162,000, which is the total profit, and divide it by my initial true investment of 93.45. 1,737% return. When do you even hear numbers like that? Is this why all the people in the world are billionaires, because of real estate mainly? You're a billionaire, it's probably tech or real estate, one or the other. So that's over 5 years. It represents a 347% return each year. It's insane. The compound annual growth rate is 77%. It's mental. This is like a house I sold years ago. This is just a snippet in time. Like, the numbers are the same wherever you go. It doesn't matter. It's just to do this stuff where it cash flows, you got to go to different places now, and you have to go to places that you can afford to buy in, right? So whether that's, we're talking about Calgary today, but we're going to do one on Edmonton and basically anywhere in Canada that is poised for market appreciation, has great cash flow, so that anybody can do this. All right. Yeah, 1737 return. Okay. So here are all of our, I didn't include my primary residence in this. Like, your primary residence basically is just a vessel to try to save some tax in this country. It's the only way to make money tax-free. So, my strategy is to hold on to a great big one and hope that it appreciates lots and I get all that money tax-free. But it's hard to calculate the return on investment when I'm paying for it, right? So I didn't include that one. So these are all of our actual investment properties. You have that compound annual growth rate here beside the total percentage after 30 years. I want you to understand that this is just market appreciation. I'm not doing that big, huge, long thing. That took me like 3 hours to do that calculation. I'm not doing that for all of these. So you have to understand the numbers are good enough without including the rent collected, mortgage paid down by tenant, the rent increases over the years, and any positive cash flow. Okay, so using 3.8%, this is what I did here with each of these investments. I'm going to choose to look at the 8.35% a year because it's the 20-year average. To me, that's more realistic than the 3.8% because it's just more realistic for me. If you look down at the bottom, the average across the board is 14.52. The new Calgary condo will be 14.27. And where this is important is comparing it to how horrible stocks perform. Okay, so I'm going to use the S&P 500 because Warren Buffett once said that, it doesn't matter how good you are in the market, you'll never beat an index fund. And I don't know if you guys know this, but he actually made $1 million bet to everybody in the world, every financial planner. And he said, if you can beat an index fund over 10 years, I'll give you $1 million. Nobody did it. So chances are this is as good as it gets, according to my man Buffett. So the S&P 500, if you take all your dividends and you reinvest them, I'm assuming you all know what dividends is. Dividends is like a payment that you get for holding the stock. So it's like if you own $100,000 worth of stock and the dividend payment's 3,000 or 3%, they give you $3,000 a year. So this is assuming you reinvest that money back into your holdings. You'd get 10.47% over 30 years. And you're like, well, geez, Shawn, I only have to just buy the stock and hold on to it. Yeah, it's not bad, but you can't leverage, right? So that's the main problem. And there's a big difference between 10.47 and 14.52 when you add 30 years of compounding interest. Okay, so look at the numbers at the bottom here. If you invest $100,000 in the S&P 500 and you earn that 10.47% over 30 years, it's going to be worth $1.9 million. I'll call it $2 million. But that same 100,000 at just 4% higher, at 14.52 over 30 years, our current average, it's almost 6 million. It's 3 times as much for 4%. That is compound interest. It's crazy. So it's like, if you got $100,000 in cash, then you can go ahead and buy that S&P 500 and it's hands off, just like the Calgary condos we're going to sell you that have property management. You just hire people to do it. There's no maintenance on condos, super easy. It's actually what I wish I had done the whole time, because if you look at the Caitlin and the Shand, those are the 2 new builds that I bought. They have the highest return, 16%. So it's like I should have just bought new builds. I would have done better overall, much better. And like I had to put a lot of blood, sweat, and tears into those other ones, renovating them and everything. So yeah, this is better. All right, next, Mike.
Yeah, so I'm going to tell you a little bit about why Calgary. So for those people who weren't here at the beginning, my name is Mike Stoner and recently started working with Shawn. And grew up, it was born and raised in Durham Region and lived in Burlington for 10 years as well before we moved out here to Calgary 3.5 years ago. So just as I think about Calgary, I just really do think it's an incredible place to live. The one thing I really appreciate is that we have amazing sunshine almost every day of the year. None of those long, gloomy winter months. So I really enjoy that. It's a great place, slower pace, less traffic. So really appreciate kind of, getting around here. Feels like you're not always bumper to bumper with everyone, which is great. And we're close to the mountains and lots of amazing outdoor activities. And really just a great place for me to raise my family and the opportunities that they're going to have in the future. Just looking forward to, just continuing to raise my family here. So Shawn's going to take a few minutes and just talk a little bit about some of the great financial and economic reasons why Calgary is a great market.
333 days a year they get sun. I feel like we get cloud in Ontario that much now. It's crazy. Anyway, I don't know. Should we just go there now? What do you guys think? Mike's selling me on it. Maybe not. Okay. Let's invest there instead. All right. So why do you want to invest there? Highest median household income in Canada. They have a thriving economy, obviously. I'm going to tell you why, because they've really diversified over the last 10 years. They are quickly becoming the tech capital of Canada because they have the lowest corporate tax rate by a measure of 30% compared to the next province. So they also have low provincial income tax, no PST. So what is it, 5% tax you pay there, Mike?
That's great. It's great.
No development fees and no land transfer tax. Canada's second most affordable housing market. Edmonton is first. Interesting fact, historically, there was never really a spread between Edmonton and Calgary. So that kind of just tells you that Calgary is a little bit nicer. I mean, in prices, everything used to cost the same price between Calgary and Edmonton. But it just shows you that Calgary is the next one. It's just like the next place people are going to go, right? It's among the world's top 25 most affordable cities for housing. Half the price of Toronto, Vancouver. We covered that. Their home sales volume is increasing, probably because they have the most inter-province migration out of anywhere by a landslide. Condos are up 20% year over year. So yeah, tech industry, the techie people, they like the condos, like walk to work, ride your scooter, whatever. There's bike paths everywhere. It's beautiful. I wouldn't own a car there. Yeah, I would. We could. But it's nice. A lot of people don't want to own cars. They want to have a nice, beautiful, luxury condo close to work, and they can scoot to work, right? Rates are 4.69% in Calgary, if you guys are wondering, to lock in. So take a look at the big companies that are going down there. Tons of headquarters for tech companies are being moved to Calgary because they have really good infrastructure for commercial industrial space. They have an international airport. They had to do something to supplement oil and gas with all this green energy stuff. So they've been working on this for 10 years, and it's really taken off. From 2015 to 2020, the percentage of employment in tech went up almost 18%. All the companies there are just exploding, and you got to wonder why. 30% lower taxes. Hello, obviously you're going to explode. If I had 30% of my taxes back that I can invest into my company, probably be retired by now, right? So they're growing like crazy. It's obviously they're going to, right? And they have the people coming there to employ. They have a much younger worker base than we do here. So yeah. Next one. All right, some other cool reasons why a lot of people are investing in Calgary. No rent control. I have a duplex sitting empty in Oshawa right now, which breaks my heart because there's people that need places to live, but it's super risky to put people in it, when I know I want to sell it. So my brother right now has somebody that's been living in his house for 8 or 9 months. rent-free. He's in the main floor of the bungalow, and he's such a disturbance. He can't even rent the basement out. So it's cost my brother $4,000 a month. Won't pay him, won't leave. Takes like a year to kick somebody out. And to boot, if your house is built after 2018, or before 2018, it's subjected to rent control, which means the government tells you every year that you can raise by 2% or 1.8 or 1.5 or whatever it is. And it doesn't actually keep up with the true rate of rent inflation. So what happens is tenants will stay somewhere for a really long time because you can't kick them out for no reason. And then they get this super cheap rent. And then you want to sell the property, tenant won't leave, and it affects your sale price by a lot. Calgary, no rent control. You raise the rents after your contract. You can ask people to leave if you don't like them after the contract. Evictions, when they are necessary, they're much more efficient. Like I've heard it takes like, under a month to get people out. So yeah. Also low cost of entry. So it's like you're going to buy the units that we're going to show you here. Again, they'd be double the price in Toronto, right? That's without factoring in the fact that you got development fees and land transfer tax, which is double. So you buy a $1 million condo in Toronto and you're going to have like 20 something thousand worth of property tax that you got to pay up front. That's cash. That affects your return. So you don't have that there. And then the builders, the reputable ones. So I just want to touch base on that. It's very important if you're going to buy an investment condo, you don't want to just shop for the best price. Who builds it really matters, and I'll tell you why. If it's a nobody, sometimes what they'll do is they'll list this project at a very appealing price, and they'll sell out, right? And that's how they obtain financing to build the project, right? So it's like the banks will tell them, okay, as soon as you sell 75%, we'll fund the project. Okay, so they fire sale these things. And then they use the funds that they got from the bank to start the project, and they start building. They get almost done. Oh my goodness, the market's gone up 50% in the 4.5 years it took to build this thing. They just declare bankruptcy, give everybody their deposit back with the money they got from the bank, and then start a new company. The building's 3/4 built. They finish it, sell them at the new prices. So you just lost 4 or 5 years, 3 years, whatever, of market appreciation, So you got to pick reputable builders. So like we're showing you stuff here from a company named Truman, and they're a good company, like 1,500 or something like that, 5-star reviews across multiple platforms. Like super high satisfaction from their customers, which you don't normally get with these big builders, but obviously somebody cares there, and maybe they can just use that 30% tax savings to provide excellent customer service to their people. Who knows? Like, wouldn't that be a wild thing? Okay, so the incentives they're offering: 3 years rent guarantee, 3 years no condo fees, and 3 years free property management. That's pretty cool. So next one.
Yeah, maybe just a quick shout out, just as mentioned earlier. It doesn't look like our chat's working, but if you do have a question, we're going to spend some time answering questions at the end of our time here. And so I believe there's a question section there. You can just pop that in there and we'll make sure that we address those before we head out.
Okay, so remember I told you we were going to plan for the conservative, So the conservative is you buy this condo and you plan to keep it for 30 years, and then you're going to decide what to do with it. Maybe you keep it, whatever, I don't know. This is a 30-year plan. You win with time. Okay, the secret is buying stuff that you can hang on to forever. So it's like part of the reason I'm selling that Crerar house is like, if it rains just the right way, it kind of leaks. It does it once every 3 years, but boy, does it ever tick me off when it happens. You just get home from work and the tenants call you and it's like, I've made hundreds of thousands of dollars on this thing. It doesn't matter. It ticks me right off when I got to deal with that after I'm dealing with my kids and my day and everything else, right? So the secret is to buy stuff that you can hang on forever, because the one negative with real estate is there's too much friction costs. So the secret is just like you buy something that you like and you keep it, right? So what we're after here is a very conservative, the condo goes from 400,000. I'm going to teach you how to buy it with 25 grand. And then it goes to 1.2 million and the tenant paid for it. And it didn't cost you anything monthly. Like that's what we're after here. That's pretty good. You make $1.2 million off your 25,000. It's a good return, right? But let's have some fun and be aware of what could happen because it's exciting and it happened here. So like, why wouldn't it happen there kind of thing, right? So I'm going to show you how we're going to turn $25,500 into $298,000 in 5.5 years. So this is for people that you've been in your house for a while and you got equity. Maybe you have other investments, but like, let's say you can get approved for an additional 500,000 worth of financing, right? And you got that kind of equity in your house, or you only need 80,000 worth of equity in your house, but you can get approved for that 500 grand, right? Or no, you don't even need that. What am I saying? Oh yeah, you do. You need 500. So what you're going to do is open a home equity line of credit on your house, right? For 40,000, or just get the 80 right out of the gate. And right now you're going to pay 7.5% interest. Now you're not going to be worried about paying that 40 grand back. Like you're just going to cover the interest payments, which on 40 grand is about $250 a month. So over 2.5 years, you're going to incur $7,500 worth of interest. 2.5 years is the time that you put 10% down today, 40,000 of 400, right? And you close on it in 2.5 years. So in 2.5 years, you got to put your additional down payment to come up to 20%. That's a requirement for buying investment property in Canada. You can only pay less if you're going to live in it. So now you have 80,000 on your home equity line of credit, and you are responsible for paying $500 a month from this point on for 3 years. That'll cost you 18 grand, right? So we are 5.5 years in to this adventure of investing in real estate, and you've paid $25,500 in interest to borrow the 80 grand from your home line of credit. Okay. So you have your carrying costs for the unit. You pay 400 grand for it. You're going to mortgage 320, 5% interest. Property taxes are about 2 grand. Monthly carrying costs are going to be 1873, which is 22,000 per year. Market rent right now is 2,100. It went up 8.5% last year. So by the time you close on this, that could be theoretically quite a bit higher. You're going to collect 25,200 in yearly rent, which is cash flow of $8,100 over 3 years. So already your cash flow covers a good large portion of your monthly interest payment, right? So that's pretty cool. Now you're also going to pay down the mortgage to the tune of $15,000 in that time, right? Where the tenant is. All right, so we're going to use this super exciting number of 10%, right? So they went up 20% last year. Let's assume for the next 5.5 years, they go up at 10% because Calgary is just going to boom and they're half the price of Toronto and they probably shouldn't be, right? So again, this is like a super exciting what if, I don't think it's impossible. I mean, we saw in Durham here multiple years of like over 20% market appreciation because Oshawa was undervalued to the GTA, just like Calgary is undervalued to Canada. So it's like, I have very much of the mindset that if it can happen here, it can happen there, or if it happened over there, it can happen here or whatever, right? So yeah, very real possibility that this thing will be 675 in 5.5 years, right? You had profit from the mortgage pay down and cash flow of $23,000. So total profit of 298,000, or 1,172% return on your money. So here's where it gets magical. Infinite returns, So if you have 675 of market value and you took out a 3-year mortgage and now it's time to refinance, okay, you know, you can pull out because you only owe 320 on it, right? So you got $350,000 worth of equity there. Pull out your 105,000, make yourself whole from the $25,000 interest that you paid. Now you have $0 invested in it and $200,000 worth of equity. It's free house. Literally, it's free house. Just took time, you know? Like, it's free. It's literally free. So then at that time, you refinance, let's say it's still 5%, you know? I'm going to cry if it's still 5% by then. But, you know, let's assume it's going to go down. But if it doesn't, whatever, it's 5%. Your monthly payment after taking the money out is $2,200. Projected rent based on 4% a year, half of what they did last year. Conservative, 25. Now you're going to incur condo fees of $350 a month. And you're going to have to hire a property management company at $200 a month. So you're going to be negative cash flow, assuming all of these things, all of them are like super uber conservative, and we don't see like true appreciation. Negative $215 a month. So you're holding an asset worth $675,000 by investing $215 a month. But in all reality, it's going to be cash flow again. You get a couple $100 in your pocket a month. It's so crazy. It like ticks me off sometimes, you know? So the magic is you have to be able to get approved for the 500K, right? That's the hurdle here. But like, it's simple. To me, it's simple math. Like I always was able to kind of decipher this stuff since I was young, really, like honestly. So yeah, that's how you calculate the true return on your true investment, which is only the interest on the interest. This is 100% financed, you know? So yeah. All right, so another cool thing about rents, right? Again, we're trying to keep this thing for 30 years. Mike, is that one in the middle, like prices? What is that?
The one down here in the middle, the gray area here.
Yeah. What's that?
Sorry, that's just that's like the time frame that we're zoomed in here on this chart. So
Oh, okay, right.
yeah,
Yeah, it looks much more aggressive than it actually is,
yeah,
right?
yeah, absolutely.
Okay. So the cool thing about like when things go really bad in real estate, so like right now, rates went up, house prices dropped 30% or whatever. Guess what? Rents went up. Like whenever there's horrible things going on, it floods the market with like a ton of amazing tenants because it's like, let's say there's a ton of people that have to sell their house because they can't afford to renew, but like they still have equity in their house. So they're like really good tenants and they're like normally homeowners. So there's like, it puts so much pressure on the rental market that it goes up, right? So it's like, again, if you plan for 30 years, you're going to have dips. You're going to have 30% drops. You know, it doesn't matter. We're after that end number. And like, it's like when you're ready to sell after 30 years, if you're in a dip, hold it for a couple more and just wait. Like, time's your friend, doesn't matter, right? But, you know, even when Calgary went through the crazy recession that they did from oil and gas, again, that's like 10 years ago that they started diversifying into tech. And this is why, because oil and gas went bye-bye. The average rents only dropped by $100. It's not a lot, right? Like we're looking at properties here that are going to have a couple $100 cash flow. So it's not a big deal. And yeah, the next time they go through something like this, you know, it might go up. So like it does here. So yeah, there you can see from 21 to 22 went up 8.5%. I love teaching this stuff. You guys can't tell? Yeah. Look at this global news. Price of Calgary townhomes, fastest growing in Canada. Everybody wants to go to Calgary and have sunshine all the time.
Awesome.
All right, Mike's going to tell us all about the current deals we got going on here.
Yeah. So wanted to go through some different opportunities that we have right now that we wanted to highlight here today. And so as Shawn mentioned earlier, we are excited to be partnering with Truman Homes and wanted to show some of their different projects. You know, they're Calgary's biggest builder, and they have some really exciting condos and different projects available. And so we want to go through those. So right here are just kind of the four main ones listed and kind of in when they're going to close. And so we'll go through them though, kind of based on some of the ones that we're excited about the most. And so first, we're going to start off with the Lincoln. So the Lincoln is this pretty stunning high-rise condo building that is being built downtown. So just kind of maybe quickly to give you some idea of if you've never been to Calgary. So we kind of are broken into quadrants with like kind of downtown being the hub, and then we have the northwest, northeast, southwest, and southeast. So you might see that kind of language going along, but this is really heart of downtown. It's about a 5-minute walk to most of the major workplaces. It's only about 10 minutes from like the Stampede grounds, which is a big, we have that huge event here every year. And so it's really a great neighborhood and something that, as Shawn was mentioning, for those people who are in tech and want to be close to where they work, this is really an exciting project. So this is really right now their flagship premium residence that they're building downtown, and has some really amazing amenities within the buildings as well, which I'm sure is exciting for those who are looking to move here and want to have those social aspects of living. It's also one of the most walkable neighborhoods. So the Beltline is a super walkable. You can get to shops, great restaurants. We have our commuter rail downtown as well, which is easy to walk to. And they're currently in the process of they're in the planning phases right now of building a rail line that will connect downtown to the airport, similar to the Union Pearson Express in Toronto there. We're working on something like that here, and that will only make the downtown more accessible for people as they come. So some of the cool amenities they have here, they have really neat kind of pool and fitness area. They have a games room, they have a bowling alley, and some pretty neat outdoor space as well for the tenants or for the owners.
So I want to tell you guys about 80 Bond Street in Oshawa. Like young business professionals love the luxury vibe condos. They eat them up. So 80 Bond is a project in Oshawa, and they did it kind of like this, like nice luxury vibe, super techie. So you scan in with a key fob and all that stuff. And when they came out for rent, they were charging 300 and change a square foot. So think about this for a second. You're on Bond Street in Oshawa, and you're paying $3,000 a month for a 1,000 square foot condo in rent. It's mental. It's insane. And that's when they came out there. I guarantee they're more now. I bet you they're 32, 3,300. So same thing in Seattle. Seattle's a huge tech hub. Like they got Microsoft, Apple, they're all there. And the buildings like this there come at a premium for rent. And you just get I like the caliber of tenant that this is going to attract. You're going to attract a young professional. They're going to pay their rent. So that's why I like this one.
Yeah, so there's two kind of two floor plans that we're looking at here. The one is the Fairbanks and the other is the Armstrong. And so kind of recommending, if you're looking to get into an investment here in Calgary, there's 2-bedroom units, 2-bedroom, 2-bath. So both of these fall into that. And so the Fairbanks is slightly bigger by about 40 square feet, has a really interesting layout. And, we have 2 bedrooms, 2 complete bathrooms for each of the bedrooms, and has like a pretty cool island. Really
that is a
spacious kitchen.
Way better layout than anything in Toronto. Sorry, Mike. Sorry for interrupting, but
right.
like that layout is beautiful. look down the bottom there where you come in, you got a little coat closet and, you know, nice open kitchen and living space, and then the 2 full-size bedrooms. Like there's nothing in Toronto like that's laid out quite like that with 750 square feet. Brilliant design. I love it. You know, you got a huge walk-in closet in the master there. Like when do you get that in a condo? For anybody that's been in the Aspen Springs condo in Bowmanville, you got this huge hallway, so much wasted space. It's only 1 bathroom, and the second bedroom is so tiny. They're horrible compared to this. This is a brilliant layout. I absolutely love it.
Yeah, absolutely. They're really stunning looking, and again, really high end features in these properties as well, and some of the incentives that we'll take a look at in a second here. And then we have the second one, Armstrong, a little bit smaller, different layout, but similarly still 2 full bathrooms. But yeah, just kind of the bedrooms being both on the one side of the unit, and that's coming in at starting at 556. And so yeah, there's lots of different options in the building depending on kind of what you're looking to invest, and happy to go through all those options
I
if you're
looked at them
interested.
all. Fairbanks is the best.
Yeah, it's pretty amazing. So just kind of what do the kind of next steps look like here? So currently it is there's 2 phases for their sales. Currently they are selling both phase 1 and phase 2 units, and the possession date is obviously based on completion of the tower, but they're determining between 2027 and 2029. There's 2 options for deposit structures, a 10 and a 20% down, and that's kind of more upfront. And you can see that on the right side there. So definitely the higher deposit amount is going to give you those benefits. It's going to give you the free storage locker, the free parking stall, and that's a value of about $27,000 over the 10% deposit. Some of the other great benefits that we've been able to achieve with Truman. This one, as we mentioned earlier, has the 3 years of free condo fees. It has a 3-year rental guarantee. So that means that if you can't find somebody to go in there, then they're going to still give you payment for having that vacant. And then they're also including a 3 years of free property management as well. There's also one of the upgrades is $20,000 in free upgrades. You get a paneled fridge, you get a quartz kitchen backsplash, painted ceilings, upgraded ensuite shower door. So definitely some great features to make it feel much more high end. And for those kind of looking,
the deposit guys, they have you like 5% due at 90 days, 7.5 due at 720 or 270, and then balance to 10% at 450 days. We don't recommend doing that. Just like put the 10% down and like just set it and forget it, because if you miss that by 1 day, they take your deposit and resell the unit, and they will sell it in like 2 seconds. So just give the deposit. It's not worth saving a couple $100 total in interest.
Yeah, you don't want to miss out so far along in the project because of like a technicality. Okay, another unit, interestingly, also in the Beltline. I was looking more into this, and it's actually only about a block away from the Lincoln. And so another stunning building, but this one has been on the market for a little bit longer, and so getting really close to being sold out on this unit. And so still some of those amazing features that we saw in the Lincoln, with really high-end premium features, great neighborhood as said before, and some really beautiful finishes within the units. But for this one, they only have, I think it's about 10 units left in the building, and they're only the 1 bedroom, 1 bath. So going to be a lot smaller, but still, if you're looking for something that is a little different, then this is pretty interesting. So this one, you kind of can see there in the center, there's like that open area. That's actually a really neat part of the building. They have a lounge up there. They have a movie theater and a golf simulator, and then like an outdoor patio with like a dog run and stuff like that. So it is a little more of a pet friendly building compared to the other unit. So in terms of the two floor plates that are, or floor plans that are available, are the ones that we see here. So we see the signature and the junior. So signature's on the left there, coming in at 479 square feet. So not as great of a rendering on this one as they had on the Lincoln, but definitely, you know, a good space and coming in a little bit under what the 2 bedroom units on the Lincoln are going for. So the signature
Guys, these are like only 50 grand less, right? It's because it's so far in the future. You're paying today, you know, but it's 2027 to 2029. You know what I mean? So that's why that happens. And it can be beneficial having a longer close like that, because you're getting market appreciation and you don't even have to close on it. You don't have to worry about tenants, mortgage, nothing. So for example, on the 7th, so next Friday, I close on a property that Caitlin property, and I bought it in 2017. I'm just getting it now. So I paid 400 grand for it, and it's probably worth me about 700 today. But like, I haven't closed on it. I made 300 grand on them holding on to my 40,000. You know, so not a horrible thing.
Absolutely. Yeah. So yeah, definitely getting that opportunity to kind of, you get that future proof of your investment, because you're making appreciation on the total value, but only having to put down that you know, that small amount, the 20%. And so
Until you close.
until you close. Yeah.
Yeah.
And then yeah, so starting the signatures are starting at 495.9, and the smaller juniors are at 489.9. But again, as mentioned, there's only about 10 units left on across both of those floor plans. So this one is a little bit is finishing a little bit sooner, in between 2027 and 2028. So it's likely going to be done first. And some of the benefits, similar free storage locker. This one only has a discounted parking stall and then has the free 20,000 in free upgrades. But one of the incentives they're trying to do, just to kind of, I think, as they have these last few units, they are offering $20,000 cash back on closing for these units. And then the same free condo, 2 years of free condo fees, 2 years of rental guarantee, and then 2 years of free professional management services. The other option too is an interesting one is free assignment. So if you decide that, you know, you only wanted to hold on to it, or things change between when you put your down payment and when you want to actually go and take possession of it, they are offering free assignments. You can assign it to, you know, sell that claim to somebody else.
Yeah, so that's when you sell your paperwork. So let's say, you know, it's 2028, you're closing on this thing, and maybe it's worth 420, but you don't even want to close on it. So, or sorry, like 620, and you don't even want to close on it. You just sell your paperwork, and somebody will give you, you know, the difference in between your purchase price and the price you agree upon just for the paperwork, and then they'll close on it.
Yeah,
So
so
I wouldn't say assignments like a perk. Like, I don't know, they're charging you $10,000 for the assignment. So
yeah,
you know, like, here you go, it's free. I won't charge you $10,000 to do the paperwork. But yeah, that is what people charge. So yeah, it's
absolutely
free.
Yeah, special deal for you.
Yeah.
So we got two more. So we're getting close to time here. Do you want me to keep going through these projects, or do we want to open up some questions now? What do you think there, Shawn?
Yeah, fire through these, and then
Okay.
I'll read the questions.
Sounds good. Okay. Yeah. So again, if you have any questions, feel free to throw them in into the display there. We'll also, if you want to raise your hand, we can open it up to questions as well. Okay, so Clover, that is kind of, as I mentioned here, like there's different quadrants of the city. So I actually live up here in the Northwest. This is in a subdivision called Carrington, and kind of really a family-friendly neighborhood. A lot of great outdoor amenities, amazing parks, really easily accessible to we have 2 ring roads here, and so to that one ring road, which gives you access to, you know, it's about 25 minutes to downtown, 15 minutes to the airport, and lots of great shopping and it's a great place to live and to raise a family. And the Northwest is really regarded as one of the best places in the city to live, and definitely has seen some great appreciation over the years. So these condos, there's 3 floor plans available, or there's actually six of them available, but the ones that we're looking at right now would be these 3 that we see on the bottom. And again, phase 1 and phase 2 units available. So there will be a couple different buildings that make up this larger condo building. And possession, again, within 2027 to 2028. So prices are a little bit lower here than what we were seeing in the downtown. But again,
Basically free.
yeah.
Those are so cheap. I haven't seen
Yeah,
like 352. It's crazy. It's been years since we saw $300,000 properties here. Wow.
absolutely. Yeah. Yeah. And again, we're talking about a really reputable builder here. So it's not like, like Shawn was mentioning, where you're getting a great price because they're going to pull the plug on you in a few years. So
Well, think this is 25 minutes from the center of the city. Toronto is 25 minutes from one side of the center of the city to the other side of the center of the city. But like, think no traffic driving 25 minutes out of Toronto. Like you're not even really out of Toronto, right? Like you're still in the city.
absolutely.
It'd be major expensive for a 900 square foot unit like this. Like you're going to be $1 million still, right? So it's pretty fun, I think. Like it's actually close, 25 minutes. I've been to Mike's place, and it is a super nice community. They have all these like little, what is it, like a community center or whatever, right? Where we went to tennis. They have them everywhere, and you can just go, and just because you live in the community, you get access to it, and it's always full of people and kids screaming and running around and jumping and playing and stuff. It's great.
Yeah. Each of the subdivisions, or each of the communities, each have their own community association, and they usually have amenities. So like they have a park area that they're maintaining, or different services that you get by being a member of that community. So and they're always kind of competing against each other to have the best community facilities to draw people in. So definitely, that's one thing we see here in Carrington, is some really, their kind of central area is really quite amazing. So then we have, just in terms of some of the benefits, very similar. Again, all the 2-year free options, and if you're putting 20% down, you're gonna get that storage locker and the parking stall included. And they actually have laid out here what the guaranteed monthly rents are. But again, we feel like the rental market here is very strong, and we feel that especially these newer buildings, you're gonna be able to find tenants very, very easily.
And for much higher than that.
But
they do that rental amount because they know that's what it costs to float it. Yeah. So that's why they make it incentive. And like, you might be asking, well, why does the builder do that? Because they know that investors want to buy these, but they're nervous. Like, well, what if the tenant doesn't pay me? They know that's not going to happen. Like, they're that confident that they're putting their own money on the line here. So
absolutely. Yeah.
Cool.
The final one here, a little bit different. If you're feeling like you want to move up to kind of the next level, move out of kind of condos, they do have a set of a new kind of subdivision that they're building down in southeast Calgary, and called Rangeview. So Rangeview is the name of the neighborhood, and newer part of the city. And because it's newer and kind of a newer part of the development, there's a lot of great amenities that they're building into there. A lot of great parks, and the subdivisions are really being built out in a way that is really family friendly, and a lot of new shopping centers and all that kind of stuff is opening down there. So similarly, it's actually not that much further away from the city center. You're looking at about 25 to 30 minutes to downtown, and just a real place that's seen a lot of new development and growing. And because it's a little bit newer, the options down there are a little bit more affordable than different parts of the city. But still, you don't have to go significantly far out of the city in order to get those better rates. So the prices here that we've included include GST. So that includes the 5%, and we're giving you these prices here with the basement apartment. And so this would allow you to have 2 income two income units within a single building. And that would be, so if you had a single family home, those are coming in at 761. And the duplexes, which are about the same size, but obviously connected to another.
We call those semi-detached.
Yeah.
Those are semi-detached.
So
they call
that
them duplexes.
Yeah, so this picture that you see here, this is what we're talking about when we call them duplexes.
Semi.
Yeah, semi. And so those ones are 709 K with everything in. And so possession on these ones a lot quicker, Q3, Q4 2025. And if you put down 10%, you get a free garage. So that's a pretty, so that would be a laneway. We'd have a laneway in the back where they're going to put a double stall garage. So a couple things that we like about this project, the projected rents are expected to cover the carrying costs. And you can actually buy these units for below what the current resale value is of homes of this size within Calgary. And so you're already kind of ahead by buying it at this rate. And you're obviously going to enjoy that market appreciation while the unit's being built. So it's not quite as long as some of those other examples we gave you, but still, a great option if you're looking for something a little bit quicker.
When the market gets super hot, guys, the builders, like, nobody wants to wait for the house; they just want to get in, right? So quite often, the market will outpace the builders changing their prices. So that's kind of the situation here.
Yeah. So just a quick floor plan here. Don't really have enough time to go deep into it, but you can kind of see on the right here, we have our lower floor plan, which includes the the income suite, and then here is our single family home, which again, not significantly bigger, but it's on its own lot and different things like that. So it's a little bit of a wider home. Okay.
Sweet.
That wraps us up.
For anybody that has WhatsApp, you should join this here. Just scan it. I haven't really started in it yet, but what we're going to do is kind of do blasts of good deals. So it's like they don't come up often, but like, should a situation come up where somebody needs out of a deal or whatever, and you can do an assignment sale or something, or somebody didn't pay the deposit on time and there's a good deal and you can buy it, we're going to blast them out there and just share information on new buildings, because it's like they do sell fast. So it's like some of them are only out for a few weeks and they're completely sold out. So this would be an easy way to kind of just be like, hey, yo guys, here's this thing. It's out now, right? So, all right, let's answer some questions here. All righty, you're welcome, Matthew. Thanks for joining us. If the deals are so lucrative, won't the properties be snatched up by foreign investors as happened in Toronto? Yes, but we do have the foreign investor tax now. So that crazy thing is they incur this tax. I should know what it is, but I don't work with foreign investors, but they're still buying it. They're paying the tax. They're still buying it. So can you look that up, Mike, while I'm answering questions with the foreign investor taxes? So if it's secondary property, you pay capital gains tax if you sell, right? Yes. So the idea is to rent, hold. Yes, you want to rent it out, hold it forever. As soon as you go to sell it, that's part of that friction cost, right? And the whole idea is holding this big nest egg, the market value, for as long as you possibly can without selling it and without incurring the tax. Like, you're going to pay the tax no matter what. Death and taxes, can't get away from them, right? So you will pay it, but the whole idea is if you pay it later, you grew that nest egg at a much more exponential rate. Can we talk about an alternative example? Oh, go ahead.
In Ontario, it's 25%.
Yeah, and they're still buying.
Yeah, crazy.
So, yeah. Okay, so can we talk about an alternative example? First time home buyer is cash instead of current using HELOC. Okay, those are all of my examples. Examples, right? So 14.5 whatever percent compound annual growth rate. I put 20% down on all of those properties, so it'd be no different than you. So you're not going to get like the super exciting 1,700% return on your money, because pretty much the entire 100% of the property is financed, but you're still going to make 300 or 400% on your money. right? The real magic happens when you finance the entire thing. You don't actually have a ton of money in it. Like that's where the crazy, insane number comes from. But still, 300-400%. You can't do that in the market in that amount of time. So my portfolio there, that is a prime example of that, because I did that. You know, if you have to sell or duplex is more difficult to sell, no, doesn't. No, it's not. Everything's on fire there right now. Like multiple offers, selling 150K over asking, all the same stuff that we are still going through. You know, we sold 2 properties today. One had 9 offers, one had 7. We sold one yesterday that had 6 offers. Like all of our properties are getting multiple offers, but it's probably because they look so nice. Shameless little plug there. Is your down payment secure if the builder goes bankrupt? No, not 100%. You're the last to get paid back. That's why you want to work with a reputable builder that knows what they're doing, and you know, they have a reputation to protect, right? So that's why it's crucial to hire the right person. For the rent guarantees, that's set to what they have it at for the 3 years. So if they say what they will guarantee 2,100 is locked in at 2,100 for the 3 years, yes, it is. Yeah. So again, by the time you close on this, rents should be significantly higher, maybe $100 a month higher or more. And yeah, you're just going to rent it out for market value. The rent guarantee is not a factor. So,
and just to follow up on that too, so they base that on like a percentage of the sale price. And so, you know, when we talk about we showed you the rental for the Clover there, they had, you know, because of some of those other projects being further out, and it's really dependent on each of those floor plans, right? So if you're going to buy the penthouse, that obviously is going to have a specific, because it's going to be the most expensive, you know, that's going to have a certain rental guarantee, and it's based as a percentage of the sale price.
the condo fees for the building that we broke down, they're approximately $350 a month, and they do go up over time. Like all condo buildings, the fees go up over time. That's why I kind of like the 30-year mark. Like condos, you know, maybe even a little bit before 30 years, 25 or so, they are good to sell and flip into a new building, because by then they're starting to get tired and everything, right? So if we're older investors, is the return still favorable for a 15-year outlook? So again, yes, with the conservative rates, you know, 15 years, the unit's still going to probably triple, right? With rates that I anticipate, it's going to do a lot more than that. So, you know, it's going to almost double in the first 5 years. So, yeah, it doesn't have to be a 30-year plan, but it's like Sherry, you've kind of seen the way real estate investing works already. You know, it doesn't necessarily have to be a long-term thing, but 15 years would be plenty of time to grow there.
The one example we gave there was 5.5 years, right? We looked at what it would look like in 5.5 years, and it was still very, very impressive results. So, you know, if you're adding that extra time, we saw there with the compounding, right? You're getting that compounded benefit the longer you can hold on to it, and whatever that is for you is kind of.
Yeah, so I want to share something else with you guys that's kind of interesting about owning real estate. So it's like you're like, okay, I want to cash out. Okay, so you have an option. You have 2 options. The goal is to get money, right? So let's say you've owned this thing for 20 years and you're getting tired of it or whatever. You just like want to enjoy life and buy a stupid Corvette or something, right? You have 2 options. You can sell it and you're going to incur all those friction costs, and then you're not going to have an asset anymore, right? Or you refinance it. So when you sell it, you're going to incur the capital gains. You're going to pay real estate fees. You're going to pay lawyer fees, all that stuff. And then if you want to ever reinvest, you're going to have all that friction costs again, right? So when you hold a property personally and you pull debt out of it, you're not taxed on that money. You're taxed when you sell the house. So it's like, if the goal is to get cash, so I want 200 grand to go and, you know, I don't know, go to one of those Tahiti bungalows somewhere, like, and just spend a ridiculous amount of money because I feel like it. I don't know. You want 200 grand. You can sell it and get your 200 grand and incur all the fees, or just borrow against it. It's still going to cash flow because you've owned it for 20 years and your payment stayed the same. That's the cool thing about debt is, you know, your payment stays the same and rent goes up over time. So it's like you refinance, bring your cost of ownership up closer to rent so it still cash flows, and you get the money tax free. Okay. So where people get in trouble is they do that again and again and again and again. And then all of a sudden they have to sell it for some reason, and they've already taken all the money out. So there's less equity, but they still got to pay the tax where it grew. So like I keep my portfolio 50% paid off in around there, for that reason, because I never want to be trapped in that death cycle. Right. So if you're just buying one or two, it's not a big deal. But yeah, when you get six of them and you're messing around with that, it can become problematic. Would it be more beneficial to buy more condos outside of the city or one of the ones right downtown? Honestly, I think they're both, you're holding, they're going to appreciate at the same rate, right? They went up 20% last year. So it's like if you can hold one unit and it's a larger market value, then you're going to make more money by dealing with one unit, right? So at the end of the day, if they float themselves, you want to, the goal is to hold the largest chunk of market value over the longest period of time. So I would go with the more expensive one and then have less people to deal with, right? But like ultimately, if you can't get approved for the expensive one, the cheaper one is going to be just as good. So it doesn't really matter. It just depends on your situation and how much you can get approved for. Do you need a representative when you reside in Ontario and rent in Calgary? So they provide the free property management for 3 years, and their goal for that is basically to do an easy handoff for you. So it's like you get the tenant in there, it's easy. They'll probably stay there, maybe, but if not, after 3 years, the rent has increased enough for you to now pay a property management company and still have a cash flow, right? So you don't need it. Like you can manage it. But again, the whole goal here is to keep something for a long period of time. The last thing you want it doing is burdening your life and trying to find a tenant while you're in Ontario there. Just pay the property management company. It's worth it. What is the projected increase in condo fees each year? No way to know that. But I can tell you, like, buildings go from, you know, $300, they'll start at $300, and then, you know, 30 years later they'll be $1,000, you know. So that's just the way it is. Is there any ability to Airbnb versus rental in downtown condos? You got any laws there, Mike? I don't know.
They have not enacted anything as of yet, but it's definitely something that's kind of the one, risk that we have right now, right? Is that there's a lot of pressure on the Canadian real estate market, and cities are starting to get a little bit, hey, we don't want Airbnbs anymore, and they just, you have this property that you've set up, and maybe it's not now is you have to go a different direction with it. And so there's nothing that I'm aware of right now. But again, we've seen those market swings happen pretty quickly. But yeah,
I wouldn't plan for that because, again, like, this is supposed to be something sitting in the background making you money. Like, we all have day jobs here, right? Though I actually have considered making real estate investing my day job because, like I said, I make more money at it than I do selling real estate. So I was like, why don't I just only do that? I don't know. I like selling real estate.
Yeah, maybe what we'll do, maybe we'll take a look into Airbnb and try to run the numbers on that so we can look at it, because yeah, I know with some of the big events we have downtown, like the Stampede, like those rentals are very lucrative during those times.
At the end of the day, it's like if you have a spare time that you can manage that, yeah, you'll squeeze way more cash flow out of it, and it can, like, actually end up supplementing your income. I have a ton of friends that, like, this is all they do now is Airbnb stuff, usually like cottages, or I have this one impressive buddy that builds villas in Tulum, 14 bedroom villas. They cost 1.5 million US to build, and he pays them off in 3 years because they generate like $500 US a year in rent. So yeah, I mean, if you want to make a job out of it, then that's the route you go. But if you want it in the background, then to start out, I would recommend just a monthly thing. Most restaurants do not allow. Yeah, most people in Toronto don't. They don't allow the Airbnb. So again, I wouldn't plan for that. Plan for the more sure thing for sure. So yeah. Anyway, that's all we got for you guys. Unless there's any other questions, fire them in the chat now. But I appreciate you all coming. Yeah, at the end of the day, if you can't tell, I'm very passionate about this. I got Michael's help. We got platinum access for everybody with Truman, which is pretty cool. And yeah, if you have any questions, just call me, email me, whatever. Like, there is no stupid question with this stuff. And if you've been kind of like sitting on the sidelines, you know, watching everybody else make millions of dollars in real estate, then, you know, I'll tell you right now, can you pull up the WhatsApp code there, Mike?
Yeah, I'm just pulling it up now. Yep.
Like the riskiest thing is taking no risk. You know, so I bought my first house in 2010 and like everybody around me is like, don't do it. The market's bad. It's so scary. Don't buy it. Like you're reading news articles and it's like world economic collapse, 2008. The bankers got us, whatever. Everyone was pissed off. And I'm just like, I don't care. I'm 20, you have no idea what's going on, or let's just buy a house. Why not? Free beer and wings. And yeah, look where we are now. So yeah. Yeah, I wouldn't be very afraid of this. Just think of it logically, you know, think back at that list of 20 most expensive cities in the world when Calgary is normally for like overall happiness in the top 5. Yeah, it's makes perfect sense that it shouldn't be 1/10 the price of some of them on there. We do have a mortgage broker. I think she's here actually. Her name's Laura Beam. And yeah, you would want to use her. And yeah, there's the WhatsApp. How close is it to hike and mountain bike?
Yeah. So if you want to make it like kind of deeper into the Rockies, you're about an hour and a half. But you can hit, we have like this amazing green space, like Kananaskis country. You know, you can get there 45 minutes. You can be on there. I know that my family, we snowboard and ski, and the place, which is right on, is the closest mountain, is 1 hour from our house, right to the, like basically the chairlift. So it's pretty amazing to be skiing on these, you know, these little you know, little hills. Like you know, I grew up on Kirby there, right? But you're proper mountain skiing.
Yeah. So how you make money? It's the market appreciation, man. So it's invisible. It's equity. It's net worth. It's yeah. If you want to live off it, the monthly rental money, that would be like more of an Airbnb route. Or yeah, you collect a number of properties. I've got you know, friends that are pulling in, you know, $10,000 a month positive cash flow with their portfolios, and now they just retire because they live off the positive cash flow and the properties are still going up. So yeah. What's the timeline to get started? Yesterday. What are the first steps for an existing homeowner? You would contact your bank where you have your mortgage and see about getting approved for a mortgage and a HELOC, or Laura can talk to you with that as well. But yeah, you just talk to the bank and see if the financing is possible, and you just say, I want to know what I can get. You know, if it's 300, perfect. If it's 200, maybe we find you something in Edmonton with cash flow. Like they'll have their time too, right? The 3 years of free fees, that begin when you gain possession of the unit? Yes, it does. Yeah, once you take possession. For the rent guarantees, that's what you have for 3 years. They guarantee 2,100. It is locked in for 3 years. Yeah. Oh, okay. We answered that.
We already answered those ones. Yeah.
Perfect.
Okay. Yeah, if there's
Nice.
any more questions, feel free. And yeah, kind of as Shawn mentioned, reach out if you even want to talk through what those numbers look like, or if you're interested in those next steps. If you're saying, hey, I'm ready yesterday to buy the first one, then let's talk about how we can move forward with that.
Yeah. All right, guys, I appreciate you joining. Yeah, until the next one, or until you call me, have a great evening. And yeah, thanks, Mike. Good job. All right. See you,
Thanks,
everyone.
everyone.